Bond markets, the ultimate judge and executioner of financial crises, are starting to think Donald Trump can actually fight inflation and stave off a financial collapse that was looking inevitable under Joe Biden's handlers. Will our corrupt economic aristocracy be issuing apologies? So specifically, the yield or the interest rate on the 10-year bond is collapsing. This is a good thing because it's a kind of thermometer warning of any fiscal crisis. Why the 10-year? Because 10 years is long enough to boil out the noise from the economic cycle, the boom-bust, and it tells you what's structurally happening with the economy. That means three things: economic growth, inflation, and the odds our government will default on the national debt. That could be a so-called soft default, meaning they let inflation run hot to melt away the debt, or a hard default, where they literally issue IOUs like several states did in the 2008 crisis. Now, under Joe Biden, the 10-year had been marching up relentlessly, which is bad. The main driver, of course, was inflation, which has been stuck around 3% for the past year. Along with Biden's eye-watering $2 trillion budget deficits that were raising fears that markets could not digest all of that debt. These took the 10-year from 1.1% on Biden's inauguration day to 4.3% by the recent election. After a brief dip following Trump's win, the 10-year then started grinding up, hitting 4.8% 3 weeks later, as the left-wing media Borg pumped fear porn that Trump's tariffs would hike inflation, while his tax cuts would raise deficits and stress Treasury markets. The fear porn, it turns out, failed. The yield is now collapsing down a half point in just a couple weeks, and almost back to the pre-election number. So what's driving the good news? It's certainly not the Fed itself, which is now signaling it won't be cutting rates anytime soon, so that boosts the 10-year. Instead, the good news is coming from rising growth expectations and falling inflation expectations as markets realize Doge is actually making real cuts in federal spending for the first time since Bill Clinton. Meanwhile, Trump's new Treasury Secretary Scott Bessent is also doing all the right things, pushing for a so-called 3-3-3 plan that aims for 3% economic growth, which is robust, a 3% fiscal deficit, which implies a $1 trillion cut in spending, and ramping up drilling by 3 million barrels of oil per day, which brings energy prices down, which then lowers the price of everything from food to factories to electricity bills. So what's next? Brought to you by Unchained.com. Right now, the 10-year is warming to Trump on growth, inflation, and government spending. If Trump can get his agenda through Congress in terms of crisis, we are out of the woods. We can even grow into the debt, or even, dare we dream, start paying it down. Still, between here and there, it will get choppy. Growth itself raises inflation in the short run through loan creation, and even deregulation and tariffs can be temporarily inflationary as they rejigger production and supply chains. So don't be surprised if we get another jump in the 10-year, which media will jump on like vultures. But for now, markets are forecasting a Goldilocks economy with solid growth, tame inflation, and a brightening fiscal picture. That's quite a bit in just 3 weeks. Okay, we'll be watching. See you next time.